by introducing myself. My name is Erik Jan Rodenhuis. I originate from the Netherlands. My background is in industrial engineering and management at the University of Twente. Previously I worked on feasibility studies in biomass, wind energy and hydropower, amongst others in Suriname, South America. Furthermore, I worked on appropriate technologies in water, sanitation and energy. And furthermore, I hold a high interest in emission reduction mechanisms. Currently, I'm self-employed under the name start with the presentation introduction. What we're going to do this afternoon is discuss a risk evaluation tool for renewable energy project development. We use a case study to illustrate this tool. We will be talking about a 10 megawatt wind farm that consists out of 5 2 megawatt turbines located onshore near the Atlantic coast. This case is provided by Ton van de Becken from Kema Consulting, and you can find the case study also on Leonardo Energy. We'll choose a location that's familiar for me, and that's around near the Atlantic coast in the Netherlands. The presentation outline. First of all, I want to discuss a few risks in renewable energy. Then I will elaborate a bit more upon the definitions of risk, uncertainties and risk distributions. We'll shortly go into quantitative risk evaluation methods. Then I will present you the tool, and we will finish with an evaluation of the tools and rooms for questions and discussions. Please feel free to pose the questions. We will discuss them afterwards. Risks as technical risks. In the case of wind, we'll think on wind resources, if there is sufficient grid capacity, and how the project fits into the municipality zoning plan. Another approach towards risk is thinking about safeties. Maybe this picture is helpful. This is a windmill that was a problem with the electrical braking system, and therefore the over speed protection didn't work, and so we had some serial damage. It is an incident. What I would like to talk to with you about this afternoon is more about risks in project development. A popular view to think about risks in any project and in any business is thinking about risks and returns. You can see the picture below. On the one hand, we have the risks. These are all things that might go wrong. These can be technical, these can be operating risks, this can be risks that deal with the revenues or have to do with the partners you're working in the project. On the other side, we have returns, and that are the interesting things from a developer point of view or from an investor's point of view, namely what might go right. Um, what the objective of the tool was, is to create some clearness in uh, for renewable energy project developers and possible investors. And the tool must be able to improve the communication of risks to potential investors, and also give some direction to effective ways to manage project risks. Starting with the definition of risk. What is a risk? A risk, according to Knight, is an uncertainty with a probability that is known through past experience. So we can have a big cloud of uncertainties. We define risks as uncertainties where we have some background material, some data, so that you can know the probability. Another way of viewing the severity of the consequences. A third definition that might be of use is the risk volatility. That's the variability in possible outcomes within a certain confidence interval. A usually a way of looking towards a project development process is by cutting it in parts and starting with a pre-feasibility, creating a gate towards feasibility, project development, financial closure, construction, operation, and so on. Here you see zoomed in on the upper part of the previous uncertainties, and you have low funds at stake. And during the process, because you invested the time and money in it, the funds at stake become higher. And if you're lucky, uncertainties will decrease. What we see here is also you can see clearly the stages and the gates. In the first stage, from project idea, you will make a step to scrutinize the idea and um, start with a pre-feasibility study. Before you enter this phase, you usually formulate an objective and a budget for this stage and the next stages. In the pre-feasibility, you scrutinize the project idea and the opportunity idea in more detail, and if the outcome of this stage is successful, you might decide to start developing the project. After project development, you will try to find investors and partners who assist in the construction and the operation of, in this case, your wind farm. There are some tools available to help you out with the first financial analysis, and also by with applying a risk evaluation on it. A very useful tool is RedScreen, which you probably most of you will know. Also, if you have your own Excel sheet, you can work with commercial packages like At Risk or Crystal Ball. These packages work with Monte Carlo simulations, and usually they assume a few fixed parameters and do the risk analysis on a few other uncertain dynamic parameters. In RedScreen, which I will show you in the next sheet, the user can assign 90% probability intervals to a number of parameters, and the Monte Carlo simulation will pick, based on normal distributions, random values for within that probability interval. A short outlook to the case, because we will be using this in the RedScreen sheet, is the information provided by Tom van der Becken. The average wind speed is 7 meters per second at hub height. So we are talking about a Rayleigh distribution. The net energy yield of the 10 megawatt wind farm is 24,500 megawatt hours a year. The initial investment is 1.25 megawatts per million euros per megawatt. The operating cost will be 42.5 thousand euros per megawatt, and we will be expecting a refurbishment after year 10, which will be 10% of the initial investment. We assume a 20-year project lifespan and a feed-in tariff of 85 euros per megawatt hour. In the RedScreen analysis, we didn't use price escalations, we didn't use inflation or income tax, and we assumed that it is fully equity financed. So it's a bit simplified case for at this moment. You can fill in, and the assumptions mentioned before. The internal rate of return will be 11%, and you see here, you see in the figure, you see the cash flows, the cumulative cash flows, and you see that it takes us nearly 8 years to earn back the initial investment. Another part of the red screen analysis is a sensitivity analysis, and also you have the opportunity in red screen to use a quantitative risk analysis. What you can do in red screen is that you define a range for instance, the initial cost for operation and maintenance, and also for the feed-in tariff. You also see here that you can create an interval for the debt term, as we assumed that it was fully equity financed. We didn't use that in this analysis. You can see that given the interval we filled in, that the initial cost is a main influence for the internal rate of return, and that secondly the feed-in tariff and the operation and maintenance is having a slightly lower influence. And this is another graph from red screen. Given the variations we filled in, the Monte Carlo simulations generate around, I think they use 500 simulations. They create a distribution for your internal rate of return, which is visualized in this graph. As you noticed before, we chose in the red screen, we chose all parameters fixed except the initial cost, the operation and maintenance, and the feed-in tariff. A short outlook to other studies on this topic, on risk analysis in renewable energy projects. A lot of research is going on at UNEP, and part of this research is the Marsh report. It deals with a 100 megawatt wind farm in China, and they investigated what financial risks methods might be of use for the project. Which instruments can you use, and then we're talking about financial instruments like insurance, wind derivatives, and for instance more advanced carbon credit instruments. Based on voting by 31 qualified experts, the main risk they identified was the contract bankability. That means the risks that you're unable to close bankable contracts with your energy off-takers. A second risk, of the second highest risk that was identified, was the warranty non-performance. That means that you're unable to to that your counterparty is unable to meet your contractual obligations provided by the warranty. Uh, that means your off-taker for your energy will default, and you cannot refer to the contractual obligations. Um, in energy, in renewable energy, and furthermore, if you're thinking about your project as an emission reduction project, you can have various risks. In this figure from the program of capacity development for CDM, from it's might be complicated to structure all these risks. Um, Then we're going to more qualitative risk evaluations, because as you will understand, it is rather difficult to think about um, a probability distribution of your off-taker's default, of a probability distribution of your contract bankability. And a usual view to qualitative risk evaluation is that you're using a matrix, and you're on one axis you place the consequences, and on the other axis you place the likelihood of occurrence. You can expand this a bit further by defining the consequences that is of slightly influence to your internal rate of return, for instance. On the other hand, catastrophic risk can be high. It can be a high loss for your company. Um, Likelihood, we can also turn that into a semi-quantitative risk evaluation by saying that a low likelihood is a chance from 1 out of 10,000, and a high likelihood, for instance, is a chance out of 100. Based on this, we started by designing the tool. We assumed that for most risks, risk distributions are not known, and so we decided to use an ordinals case based on qualitative criteria as displayed in the previous sheet. Return. From a banker's point of view, you could think about debt service coverage ratio. We will use a risk categorizations, and also we will use a benchmark to describe the investors or the developers' expectations and its risk perception. In this figure, you're seeing the process of the process flow of the tool, starting with the project characteristics, we will be identifying the project risks in a first for every identified risk, the probability of occurrence, and also the severity of the consequences. Based on these outcomes, we will fill in the risk priority into a traffic light matrix. We named it the traffic light matrix, and probably you will understand the title of the presentation at this moment, because its view you will see green acceptable risks up to red showstoppers unacceptable risks. At the end of the risk priority, we will, based on the different categories of risks, we will visualize the total project risk exposure. Based on this, the outcomes of this tool, you can compare them with the criteria of the potential investors, the benchmark named before, and we can decide if the project is acceptable or is unacceptable. Even we can decide to restructure the project to make it into an acceptable project. The benchmark for the severity of consequences, we chose a 4-point scale, and that goes from inessential to a marginal consequence, critical and disastrous. Everybody can decide for itself how he defines the intervals. I chose here for this project based on knowing that we calculated an internal rate of return of 11%. That it is probably not of that major importance if the project performs lower than 9%. Of course, we would like to have the 11%, but the 9 is still very acceptable. For the next class, we for the marginal consequences, the outcome is between 5% and 9%. It starts becoming critical if the project performs below, and a loss is of course extremely disastrous. If a developer is working from a portfolio, it might be slightly different, because if you're having a portfolio of 10 projects and you're able to score 5 of them and the other you have a minor loss on, you formulate the interval slightly different. Here in this sheet you see a DuPont chart. what it's visualizing is that how the different financial parameters are influenced by, for instance, um, the project lead time or the construction cost, the number of emission reductions the project is delivering and at what price. Some volatility in the different items, and that it's in the end of influence on your internal rate or return, or on your, or also on your debt service coverage ratio. The risk categories are as follow. We made 5 categories: the regulatory risks, the development and construction risks, operational risks, revenue risk, and financial risks. Starting with the first category, the regulatory risks, we defined them that as risk in any sphere of influence. You see here, you see along the project's life cycle, the various permits, licenses, and regulations you're dealing with. I want to pick out one to illustrate the traffic light matrix mentioned before, and that are construction permits. If you're unknowing that in the Netherlands 64 of the onshore wind projects in preparation will not reach implementation, you can understand that there are a lot of projects that there are a lot of causes why these permits won't be available for these projects. Ranked first, based on research by Bos and Van Rijn, is that resistance from the local council the ranked 2 to 4 are also all barriers that have to do with the local council, and ranked 5 is barriers posed by a civil action committee, and what you see below is that environmental issues or safety with industrial zones or even noise is of slighter importance. For all risks we can assess the probability of occurrence, and for instance the risk of not obtaining a construction the local council is its vision is about renewable energy or about a wind turbine. If there is already a strong opposition from the local council, you can count on it that you're one of that 46% of the projects that won't be implemented. On the other side, when a local council is actively promoting the development of wind projects, um, you could say that your probability of occurrence of not obtaining a construction permit um, might be improbable. Somewhere between, if the local council is open for wind projects, but there are chances of resistance from local residents, you could say that it's imaginable that you're not obtaining a construction permit. There's something wrong with this slide. Sorry. Based on the DuPont chart, you can say if you're not obtaining the permit, you still have project development costs, but you won't be able to get any revenues. So in the end, you will be facing a loss. We can do this for the different risks, and you can say we need in Holland, that is the case. You need a temporary construction permit. You will need an environmental permit and a definite construction permit. So you have quite a few risks. In the thesis, you find in the appendices sheets where you can fill in. You can say, okay, if the local council I have to deal with is average in the Netherlands, there is a 42% probability that I won't obtain my permit. And okay, according to the definitions, we would say, okay, this is the consequences are rather critical. We can also do that for the other permits that we'll need. Of course, everybody has to decide if his project is average or based on more qualitative observations that the local council is more positive towards the project, or on the other hand more averse towards a wind project. Consequences and the severity score, we can place the risks in the traffic light matrix, and we'll see here that we have identified 3 risks that are all possible showstoppers. So we're giving the category a score of a minus. And also based on the positioning in the matrix, we can make a risk ranking. I will skip to the other slides a bit faster. We also, the second category is our development and construction risks. We use a stakeholder approach. Important on this approach is that we try to place the risks and let the risks be managed by the party that is best able to influence this risk. And if you're looking at all the contracts that your project company is closing, you can also um, look at the quality of these contracts and also at the chances that one of your stakeholders is not meeting its obligations. The same can we do for the operational risks, that are the risks that are influenced by operations and maintenance contract and the available insurance contracts. Um, Downtimes and needed corrective actions, you can almost quantify and evaluate on a quantitative base. There is a lot of available research by ESET of the University of Kassel, where they're incorporated 1500 wind turbines in their research. I will skip this slide due to time reasons. You can decide if you want a simple maintenance contract, a maintenance and repair contract, or even an extensive operation and maintenance contract and an insurance package. In the more extensive operation and maintenance contracts, you even get traffic light matrix, a complete operation and maintenance, including insurance, will probably pose us with only marginal consequences from repairs or downtimes of the deciding that we bear a risk that can have higher consequences, and also from a stakeholder's point of view, we're bearing a risk that is influenced by the party that is doing the maintenance of the wind turbines. In this case, we make a transition in the and higher return. Also, we're increasing the risk profile of the project. A project delivers. This can be energy, this can be also emission reduction. It's useful to use this figure where you can see the different cash flows. You can imagine that you're having loans or initial investments in a different category in a risk. Um, we had now we have had all the 5 categories based on the evaluations in the previous categories. We can visualize the project in a risk spider, where the green area based on our analysis are reasonable high, and therefore you see that this wind project scores outside of the acceptable area. Furthermore, you can compare in this risk spider by also inserting uh, alternative investments or alternative projects you have on hand. What we did in the tool is that we identified risks, we assessed the probability and the consequences. We have been able to identify showstoppers and rank the risks. And in the end, we visualized the total risk profile of the project. Based on this analysis, we can choose to accept or to avoid the project, or decide to change the project characteristics by minimizing or transferring risks. The tool I discussed with several experienced project developers working, for instance, in wind and biomass and landfill gas. Um, what they're doing at this moment is usually by assuming for the minor risks that they take place, and that they use conservative estimates for these risks. Um, Also, we see here on the right side of the figure the more serious risks. Identify the showstoppers, way that the risks enter the more acceptable risk range. Um, Basically, that was what the tool is about. I hope you find it interesting and useful. Um, I'm open for questions right now.
Very good, Eric. Thank you very much for the presentation. I think we are, yeah, at least on my part, I'm impressed with the potential of this tool. I can see there are a few questions coming up, so keep them coming. I'll answer at least some of them already. So a few people ask whether the slides will be available. So as I mentioned at the beginning of the webinar, the webinar is being recorded, and I will send an email to each of you with a link to this recording in the coming days, so you will have access to it. So now let's move on to the questions to Eric. So I think the first one is quite a simple one. There is I forgot his name. Atev Zayed that asks if we have a similar tool for solar energy. So can this methodology can be applied to solar energy as well, or only to wind power?
No, we used the wind power as an example. In the end, you can use this tool for all kinds of renewable energy projects. Also, if you want to use it for an emission reduction project, it's possible. It's a tool, so if you're a craftsman, you can use the tool um, on from your own point of view.
Okay, so Guillermo Soveron also asks whether the tool is available. So the red screen part of it, it's freely available on the internet, but the overall structure that you defined, is this available online?
Yes, you can download the thesis where the tool is described and use it for your own projects.
Okay, and is it applicable to Africa or other developing countries? Because I imagine there are some particularities that are well, particular or specific for Europe, or is it not so?
You can use this tool. You can use this tool for any kind of project. You can change it also based on your own needs.
Okay, thank you. So the next question is from Nikolai Parker. So he asks, regulatory certainty reduces risk for renewable energy project development. So the risk analysis model you showed was based on a fixed feed-in tariff for renewable energy in Europe. How can this risk analysis matrix account for the various range of financial incentives for renewable energy development in the United States, for example, where there is no feed-in tariff for renewable energy?
First of all, you can use the red screen part by um, filling in an interval for the tariff you're expecting. Also, you can use the red screen for different scenarios and enter the outcomes into the risks tool I presented today.
Okay, thank you. So Natalia Cortina now asks, how does the tool consider market price risk when the output production is sold directly into the market? So how is the price sensitivity included in the market, if it is?
Sorry, how does your tool consider market price risk? Um, yeah, you can calculate different scenarios and then see, based on the Dupont chart, uh, what the outcome for your internal rate of return of your project is. Um, of course, it is true that it's difficult for um, in a lot of cases to rate also the probability and the consequences, how they relate to each other. But the market price risk is certainly a risk that is taken into account in this tool.
Okay, thank you. So now we have a comment rather than a question from Oscar Salinas. So on the applicability on developing countries, he mentions that you'll have higher risks on estimating and evaluating and assessing the parameters you propose. So I guess this goes along, uh, the difficulties that we always have on getting information. So the input data, I think it's one of the biggest challenges that is faced on any modeling. So I have another question from my side. So you mentioned the downtime downtime times for renewable energy as a parameter to capitalize on your investment. So I've recently read an article where there was an evaluation of the for each different manufacturer, or you just calculate an average downtime and you work based on that? How is this approached?
I would say in the pre-feasibility stage where you don't know which supplier you will be using, I would use an average. But in the later phases, the more solid figures you have about your project and about your equipment you are using, um, I would say you use those figures for that specific type of turbine of that specific type or equipment supplier.
Okay, so I think you've just answered to the next question, which also goes. He mentions how far can we apply this tool to small and medium size deal with any project, no matter if it's small or big, correct?
I also use this tool to explain to my father what are the risks for placing photovoltaics on his garage. So yeah, you can use it from small scale to large scale projects.
Very good. For the moment, there are no more questions. I have a last one, and we're reaching the hour, so I think it's a good timing. So my question is, from all the factors you mentioned, from the financial ones to the wind availability to the permits that you need to get, what do you think, in your opinion, is the critical factor? Just one. What do you think is the most important factor for the wind case?
For the wind case, and if we're looking at wind here in Europe, it's simply the regulatory issues you have to deal with. Um, but for another case, for landfill gas used as an emission reduction project, this can be very otherwise. You maybe the price risk on the emission reductions is in that case your biggest risk.
Okay, very good. And now just a finishing question. Did you manage to convince your father? All right,
Yes.
very good. So I think with this we finish our webinar for today. I would like to thank Eric for your presentation, and I'd like to thank all the attendees for having joined us today. I will mention again, so the presentation has been recorded and will be made available in the coming days. You'll be informed on that. I would also like to invite you for next week's webinar that will be on underground cabling and what are the issues that prevent or allow underground cabling, and how can this be used for reaching the 2020 targets of the European Union. So I can see that there is an active exchange on the introductions box, so I will leave the introductions box open for a while in the meeting, so you can still exchange with your colleagues for a little while. So thank you very much to you all.